Hi everyone, real quickly I wanted to touch on the weighted average cost of capital calculation. It's actually pretty straightforward when you break it down, but the important part I think is to break it down, because if you look at it, it looks very intimidating here. But the weighted average cost of capital, this is adjusted, is just the weight of the equity, which this would be your total equity in relationship to your total assets, which would also be equal to your total liabilities plus your total equity, the V component here, times the cost of your equity. So that's one part of that equation, focusing on the equity. The next part of the equation focuses on preferred stock. So if you took your how much total preferred stock you had in relationship to your total assets or your total equity plus liabilities, multiply that times the cost of your preferred stock, that would be the second component. And then the last component here is the debt component. Take your total debt over your total equity plus your liabilities, multiply times the cost of your debt, and then multiply that times 1 minus the tax rate, because corporations can deduct the interest paid on that debt. So there is a little bit of a tax advantage to issuing debt here that we need to take into consideration. All right, so let's get started. Put together a problem similar to one you may have in your homework. Hollydale's is a clothing store in East Park. It paid an annual dividend of $3 last year to its shareholders and plans to increase the dividend annually at 3.2%. It has a 650,000 shares outstanding. Shares currently sell for $30 per share. Hollydale's has 22,000 semi-annual bonds outstanding with a coupon rate of 12.5%. A maturity of 14 years and a par value of $1,000. The bonds are currently selling for $1,374.92 per bond. What is the weighted average cost of capital for Hollydale's if the corporate tax rate is 34%? Well, there's only two ways that we can calculate the equity component. One is using the dividend growth model, which is what we need to do here because they talk about dividends and the growth rate. The other one is the security market line, the SML formula, which would deal with the risk-free rate and the market rate. So let's go ahead and plug in. It's just a simple matter. Once you've got the formula, plug in what we know. The dividend, it says, was $3. The growth rate is 3.2%, so we'll just add 0.032 there. The purchase price is $30 per stock, and the growth rate again is 0.032. Just go ahead and run that calculation then. Take the $3, multiply it times, in this case, 1.032. We need to divide that whole number, though, by the $30 cost and add then the growth rate back to those. 13.52% should be your answer to your cost of equity. Calculating the cost of debt is a simple matter of using the rate function that we did when we did time value of money calculations. You have to do a few little adjustments here. So calculating the present value, it's the selling price of the bond. It's given to you here. If you had any flotation costs or commissions for selling that bond, we would have to take that into account, but we don't have that here. Par value is $1,000, also referred to as the face value. Number of years, it's a 14-year bond. We multiply that times 2 because the bonds will pay interest twice a year. The payment is the face value or the par value of the bond multiplied by the rate, which is 12.5%. But we have to divide that by 2 because that would give us an annual payment amount, and we only need a payment every 6 months. 62.5. Go ahead, up here, formulas, financial, solve for rate. Number of periods we know is 28. The payment was 62. Present value, make sure you enter that as a negative or you're going to get the wrong, you get little nums. And then $1,000 for future value, 4%. I have to multiply that times 2 because it's giving you the 6-month rate and we need an annual rate. All right, I'm going to start over with a different, the continuation of this problem. Thank you.